Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today, we're diving deep into one of Singapore's most controversial property giants. City Developments Limited just received a flood of analyst upgrades despite trading at 17-year lows. We have 4 buy ratings and 1 hold, with price targets ranging from $4.60 to $7.30. But here's what caught my attention. The stock is trading at just $4.75, while analysts see upside potential of up to 54%. So what's really going on here? Let me break down what the analysts are seeing that retail investors might be missing. DBS maintains a buy rating with a $6.70 target, though they did slash it from $10.50 earlier. OCBC also keeps their buy rating at $6.02, while RHB is most bullish at $7.30. The only holdout is UOB Kay Hian, who downgraded to hold with a conservative $4.60 target. This tells me the market is deeply divided on CDL's prospects. The bull case is actually quite compelling when you dig into the numbers. CDL just reported phenomenal Q1 residential sales. They sold 795 units, which is an 80% jump from last year. Revenue surged 155% to $1.9 billion, primarily driven by the Ori project in Toa Payoh. This development sold 86% of its 777 units on the launch weekend alone at $2,704 per square foot. That's exceptional execution in today's challenging property market. What really impresses me is CDL's capital recycling strategy. They divested over $600 million worth of assets in 2024, including properties in China, London, and Singapore. This isn't just about raising cash. It's about optimizing their portfolio and reducing gearing. The company's net gearing ratio sits at 72%, which is manageable but elevated. These divestments should help bring that down while freeing up capital for higher return projects. Here's where it gets interesting for Singapore investors. CDL's investment properties portfolio shows remarkable resilience with 97.2% office occupancy and 96.2% retail occupancy rates. In a market where many landlords are struggling, these numbers demonstrate the quality of CDL's assets. They're also seeing positive rental reversions of 15% at City Square Mall, which suggests their commercial properties are well positioned. But let's address the elephant in the room. Why is the stock trading at 17-year lows if everything looks so rosy? The answer lies in a combination of factors that analysts might be downplaying. First, there's the board dispute legacy. While legal proceedings have been settled, corporate governance concerns still linger. Investors are watching closely to see if management can focus on execution rather than internal conflicts. The hospitality segment is another red flag that deserves attention. CDL Hospitality Trusts saw net property income drop 14.2% in Q1, with Singapore operations particularly weak. Occupancy fell to 75% from 82.1% previously, and RevPAR declined to 15.8%. While management blames a softer events calendar, this trend bears watching as tourism recovery remains uneven. From a valuation perspective, the analysts have a point. CDL is trading at 0.5 times book value and 0.3 times revalued net asset value. These are levels we haven't seen since the global financial crisis. Even accounting for the challenging environment, this seems overdone for a company with CDL's track record and asset quality. For CPF and SRS investors, CDL presents an interesting opportunity. The stock is included in both schemes, and the 2% dividend yield provides steady income. However, remember that property stocks can be volatile, so position sizing is crucial. The recent analyst upgrades suggest professional money might start flowing back, but retail investors should be prepared for continued volatility. The broader Singapore property market context is also important here. With cooling measures still in place and interest rates elevated, property developers face headwinds. However, CDL's strong pre-sales provide earnings visibility that many peers lack. Their pipeline includes the upcoming Zion Road project and overseas developments in London that could drive future growth. If you're finding this in-depth analysis valuable, Imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Singaporean investment landscape. Don't miss out on this opportunity to level up your investing journey. The link to join is in the description below. So what's my take on CDL? I'm cautiously optimistic, but with important caveats. The valuation is undeniably attractive, and the residential sales momentum is encouraging. The capital recycling strategy shows management is being proactive about portfolio optimization. However, execution risk remains elevated given the corporate governance overhang and challenging operating environment. For existing shareholders, the recent analyst upgrades provide some validation, but patience will be required. For new investors, CDL could be a contrarian play, but it's not without risks. The hospitality weakness and China exposure are ongoing concerns that could weigh on near-term performance. My recommendation would be to start with a small position if you're interested, perhaps through dollar-cost averaging. Wait for more evidence that management can execute on their promises before increasing exposure. The stock has momentum potential if property sentiment improves, but it's not a guaranteed win. The key catalysts to watch include pre-sales performance of upcoming launches, progress on asset divestments, and any signs of hospitality recovery. If CDL can deliver on these fronts while maintaining corporate governance standards, the analyst price targets become achievable. Until then, treat this as a higher risk value play rather than a core holding. That's my analysis of CDL's analyst coverage. What do you think about the stock at these levels? Are you convinced by the bull case, or do the risks outweigh the potential rewards? Let me know your thoughts in the comments below, and don't forget to subscribe for more Singapore stock analysis. I'll see you in the next video.